Welcome back. You're watching us here on Halftime Report. The other stock on our radar is Patanjali Foods. The next management reported a mixed set of third quarter numbers where, the foods and FMCG business did extremely well. There was gradual improvement in the edible oil business as well, but it continues to weigh on the company year on year. They saw, decent growth in food and FMCG, which actually reached a record high in this quarter. Sanjeev Asthana, who's the CEO at the company, joins us now. Thanks a lot, Mr. Asthana, for joining in. While, your growth drivers did well, people are still worried about the underperformance in the oil business, and that's exactly what is reflecting in the kind of post-result stock move that we are seeing as well. By when do you see good growth in the edible oil business when it comes to margins? And what kind of high-cost inventory are you still sitting on? When does it go back to this 3 to 4% band that you earlier used to operate in?
So first of all, thank you for having me. Two bits. One is the oil. Actually, we have improved substantially in this quarter. So we made nearly 2% margin. It's 100 crores plus of EBITDA that we made, which is at the back of almost 4 quarters of volatility that the company was seeing, where this started to impact both in terms of the margins, but also on the overall basis of the company's performance. So we've turned the corner now. And so the edible oil, I'm expecting the markets are more stable. All the basic measures in place are all there. We are pretty much, getting to handle this better. And so I'm hoping that the oil will be pretty much past. We have always predicted that we should be between 2 and 4% of the margin in the edible oil business. We are at 2. The work is going on that we should make it closer to 4. And I have reasonable confidence that with all the steps that have been taken in terms of getting a new ambassador in Mahendra Singh Dhoni, the distribution structure we put in place, the brand premium that we are pushing for, our oil palm plantation business is firing on all cylinders. So I'm pretty hopeful that the edible oil business should continue to do well, and it should be one of the mainstays that the company has in the key segment, because that almost nearly 70% of our revenues are derived from there. So we'll continue working on that.
Any timeline, sir, in terms of when you would want to get back to those margins of 4%? I didn't really get the timeline that you're targeting it.
So timeline is, very well defined. So, both on the investor call, what we've said, so we are at 2% now. Next year, clearly the target is that midpoint of between 2 and 4% is where we will be, maybe closer to 4. Our expectation is that, between the brand premiums and the oil palm plantation business, we should be getting closer to 4 for the next year. And you will see sequential growth quarter on quarter henceforth, where we are fairly reasonably certain that we should be getting those numbers.
All right. And in doing so, and with all the Mahendra Singh Dhoni activities, the branding you are doing, have you managed to, increase your market share as well in the oil business? Where does it stand at right now? You were targeting double digit, if I remember correctly.
So we were targeting for 5 to 6% growth, and we wanted profitable growth. So if you see our market share earlier, which used to be 8%, is closer to 9. Our volumes have grown, 6% in this quarter. And if I look at sequentially, our volumes have, grown almost 10% plus. So market is under consolidation, where we expect that we'll continue to sort of, grow at the cost of smaller players or the weaker players. Similarly, what we're expecting is that the branded, parts of the business that we're pushing for will start to improve. So pretty much, our volume growth is there. Our revenue growth will, of course, is driven by the market prices. And so will the margins will continue to improve henceforth.
Okay. What's leading to this stupendous growth that we're seeing in your food business? And you are looking to increase your market share eventually, or your share in terms of revenue from the food business, maybe to up to 50%. When does that take place by?
So we had stated 2 objectives, when we started sort of work towards repositioning the company entirely towards FMCG side, that in 5 years' time, we'll be closer to 50-50. We are maintaining our FMCG share at 30% plus. It's closer to 31% now. And so in 4 years' time, we're reasonably certain that we will be at 50-50 in terms of the share of FMCG in the revenue. The growth is, driven primarily by right now by most all the three businesses are, sort of going strong. Our biscuits business this year, we expect to close at 1,500 crores of revenue, which is nearly 20% growth. Our Nutrela business, we are expanding the category itself by converting that into umbrella brand. We've got series of launches that we did earlier. There are more which are planned. So Nutrela is going to grow our soya proteins business, so that will become a large platform. And our food business, which we acquired from the parent, is also working very well. So there, both in terms of the share of staples in the basket, as well as the work that we're doing on Chyawanprash, honey, spices, and a lot of other categories. So the margin profile also will keep improving. So my expectation is that, foods as a portion of the overall business, for this to move closer to a number which is, 18 to 20,000 crores in 5 years' time, is very much possible for us to build up that FMCG platform.
All right. Thanks a lot for joining in, giving us all those details. Would have loved to speak to you about the palm oil plantation business and perhaps at length about the cash that you have on your books as well, the acquisition plans. But we'll leave that for a mid-quarter conversation once again, Mr. Asthana. With that, we'll step into a short break. On the other side of this short break, we have Srihas Tambe, who is the MD and CEO of Biocon Biologics.